comprehensive income of the year. And that is April 2016. So we start with what? Our revenue. Get the revenue? Revenue of 15, and we told you number one, it includes what? The customer paid, so customer paid a deposit of 5 million, which Dodoma credited to its revenue account. Dodoma has not made any adjustment to inventory on the account of the deposit. So if we shall use that, then we shall use 5 million. We shall use our revenue as 15, and that's the cost. Cost of sales. Do you have cost of sales? We don't have a. We shall work on that. Okay. Number one is cost of sales. Cost of sales. Our opening inventory. We had an opening inventory of 32. Our purchase. The purchase. The raw material. Is manufacturing. Material of 150. Production cost, add that, and the production cost of 60. Less the closing inventory. We shall deal with that. Closing, let me leave a space here. I do work in number 2 for closing inventory. Note number 2. It showed a closing. So you had a closing of what? Closing of 40. And we minus the deposit. We have that deposit of 5, and we have the cost. It includes some goods that cost of 4, that require to pay off 400. Then the result for what? 35. Yeah. So the net realizable. So however, a stock done that showed closing at that. However, there were some goods. There were some damaged goods with a cost of 4 that required to be repaired. So these goods, so the cost of the goods, damaged goods, they had a cost of 4. We minus this, and we add net realizable value of 3, 5. The less of cost. Remember IS number 2. The inventory should be valued at the less of cost and net realizable value. So the net realizable is lower than the cost. So this cost is included in 40. So we minus the cost, we add the net realizable value. Will give you and that for value. Because this is 9, the two of them are. That 1 plus 3, 5. Is that 4, 5? This calculator. Yes? Yes? You have 40,000 minus 9, or plus 35 minus 9,000. Minus 4, 5. Calculate depreciation. We are told in number 4 that all depreciation should be charged with cost of sales. Number 4, the plant is depreciated at what? 25. Different plant. The cost of plant in number 4 is what? 90. 90. 25% of 90. 22,500. 25% of 90,000. have the plant that we leased. There are two types of leases. We have the finance and operating. A is operating lease because we leased, the lease was for motor vehicle for a period of what? 2 years, but the estimated useful life was 5. We leased for a duration that was less than the estimated duration of that particular asset. So that one is the operating, but part B is the finance because the lease was for a 4-year period, which was the estimated useful life of the machine. So for the finance, we lease over the useful life of the machine. So the machine had a value of what? 70 million last part in B. B, the last item in contract B. So 70 million, divide by 4 years. Is only use straight line. 70 divided by 4. 18.
17.
500. And note 4, bullet 2. The depreciable element of property has an allocated value of 50 and is being depreciated on a straight line basis over 50 years. So depreciation of property, vehicle property, 50 divided by 50. So it will give you 6,000. 6,000. So it has 50, note bullet 2. The depreciable element of the property has an allocated carrying value of 50. And also the property note number 4. Property was 90. 90. But the one that is depreciating 50. Yeah. And you're depreciating over how many years? 50. That's why we're taking 50,000 divided by 50, which is giving us 1,000. It was later revalued. We shall calculate the valuation later on so that we see the value. So when you minus, when you add this to get the cost of sales. That way. So here, 248,500 and you minus our gross profit. Then, do you have any other income? In the trade balance? There is none, huh? Okay, so let's expense. Starting with admin. Our admin, we had an expense of what? Direct directly 22. It's not an adjustment for that. Then even distribution or adjustment. Distribution expense of distribution cost. 12. And you calculate the one for finance. Finance cost. We shall deal with this here. Number 3. Finance. Finance cost. So we have any interest in the trade balance? When you have the lease rental, so we shall calculate the lease amortization. Lease amortization. And we only need 2 years. In FR, only 2 years. And we are calculating how many? 6 months, 6 months. We shall have year 1, period 1, period 2, year 2, period 3, and period 4. Because they are 6 months. We are starting with the beginning value of what? So the 70 fair value. 70,000. We are paying an installment of what contract P. The lease rentals were set at 10,000 every 6 months. Calculate the interest at 5%. 5% of 70? 3,500. So the principal will be 10, 6, 5. The end balance 70 minus 6, 5. Will be 63. 63, 500. So here, insert is 63, 500. Here is 10. 5% of this. Yes? When you minus from 10, 68.25. When you minus from 63,500, okay? 675. So number 2, period 1, which are equal to period 3. So 56, 675, 5%. Yes? 48, 48. So that 34. Is the round of what? Yeah. When you minus from 10, 71, 66. And you minus from this, 8, 509. So 49, 509. Here is 10. 5% of it. 5. So just 49. 509, 44. 175. And you minus 25. And you minus now from 49, 509. 30. 41. 984. Yeah, that. So our interest here, finance this interest for year 1. These two. This one 35 plus that 175 will give you for year 1 now 66. 66 here. So for the terminal change, I will add. Remember there are 2 types of leases. One is operating and the other one is finance. For operating contract A, we paid what? The lease rental figure for the year included what? 3,000 in respect of this lease. You see the last part of contract A? The 3,000 we shall put an IMP. It's not a finance. But the finance cost is only the interest. I've seen that, huh? Yeah. So minus to get the profit before tax. $66.5 minus 25 minus 12 minus 66.75. 20? 825. Go to our tax. Let's deal with that. Working number 4. Our tax is not number 5. So the estimated income tax liability for the year was 5. The balance of the income tax account in the true balance is the residue of the previous year after making the payment for the year. Look at the true balance. The income tax method is what remained. Yeah, 400. So it means here we shall add that. We shall take 5,000. So then 5,000 plus the 400 that we made for last year. We did not pay everything. We shall account for 5,400. The minus profit for the year. In other words, is an under provision. Under provision. So remember last year, so you go debit that income tax, which means it's an expense. Whatever we paid last year, we did not pay everything. We remain in the balance of what? 400 that we are expensing it in this particular year. So if it is on the credit, the other statement they could have used is like the previous question. They talk about under or over provision. If it is an over provision, it will be on the credit. We minus from the tax for the year. If it is under provision, it is on the debit. We add to the tax for the year. You have seen it, huh? Yeah. So you get what? And later on we shall transfer. Just before that, there is a note in there to note number 7. Let's deal with note number 7. We'll have an implication. The trade receivable will include an amount of 10 owed by a customer who experienced cash flow problem prior to the year. Dodoma Limited agreed to accept a payment of 8 in full and final settlement of the debt and to defer the payment until the 2017. The expected return on sum invested for 1 year is 10%. So we have interest receivable first and our admin. Let me just do this as admin. Admin expense as per our balance. As per our balance, we have what? 22. Yeah, 22. We have operating lease. Operating lease of 3. And we have the burdens. Remember this customer orders what? 10. But we accepted what? So accepted 8 in full and final settlement. So we are setting what? 2,000 is what we are offsetting. So this total should be 27,000. And we have the interest receivable. Interest receivable 8,000 by 10%, which will be 800. We shall receive 800. That's 10%. The expected return on sum invested for 1 year is 10%. So they will pay us plus an interest of 800. So here we shall add this admin. We change. Let me first record the interest. Interest receivable of 800. And our admin expense now of 27. So we calculate that. Profit before tax will change. I will just that. So you will add 800 and you minus this. And 625. And minus 54. 16,225. We have other comprehensive incomes. So there was an evaluation in bullet 4, number 4 bullet 2, where the depreciable, the second part of that, the depreciable level of property at an allocated carrying value of 50 and is being depreciated on straight line basis over 50 years from the date of original purchase. On 1st May 2015, the directors of Dodoma Limited revalued this property for the first time. The property had an estimated market value of 100 million as at 1st May 2015. It was found estimated that 54 million of this value relates to the depreciable element. So remember, the first May 20 what? Yeah, first May 2015. Yes? Okay. Can say that. So the depreciable, so okay. and is being depreciated on a straight line over 50 years from the date of the new purchase, so we are depreciating that. So on 1st May, that is when the revaluation took place. The directors of the Dodoma revalued the property for the first time. The property had been estimated, it was at the beginning of the year, the property had an estimated useful life of 100. On 1st May, it was further estimated at 54. Of this value relates to the depreciable element. Okay, so in this case, our evaluation, we just share this. Number 5, our evaluation on property. So it was a value now at 100. Initially it was 90. It was 90 and it has depreciated. So there is something we shall change. Because the depreciation for the current year, come back here, it should be based on 54, not 50. So 54 is at the beginning, on 1st May. That's why that it was the revaluation took place at the beginning of the year, so we shall depreciate at the beginning of the year. Change that, 54 divided by 50. So it gives you 4 divided by 50, 1080. And this one will increase by 80. So the final value will increase by 80. Will increase by 80. So 24 here. It will increase by 80. So when you change, you minus 50 minus 48 by 8 66 for 420. Plus 8 minus 27 minus 12 and minus 6675. You get 21 5 545 minus 54. Then you get 16 145 as our value there. So the now here shall check 100. This one was what? It has accumulated of. Look at the accumulated. It has accumulated of 5. Huh? Yeah. It was 5,000. So you get a gain of. So it should be 5. Huh? Yeah. It should be 5,000. So the valuation gain on property 5,000. So the top comprehensive income Diploma, repeated, statement of financial position as at 30th April 2016. Start with the non-current assets. Start with PPE. When you calculate here as our PPE, we shall have property of now 100, the valued amount, and we have depreciated it by 1080 for the year. Now that we have depreciated 1080, this value will give us what? Minus 1080, 98, 98. Then we have the plant. Plant and equipment we have 90 with an accumulated of what? 30 for the year. We depreciated it here. The plant 22,500. And you minus the 2. Keep it at 7. Keep it at 7,500. And we have now that release. List plan of 70. And it's depreciated here by 17.5. The remaining 52. Equation 52,500. Total. We add 37.5. We are 98, 20, and 20. You are 8 and 20. Yeah. 188, 920. Go to current assets. We have inventory. Here, these are the calculated. That's 4,500. We have the receivable. We have the receivable what? Is it 50? Minus 2, the balance. Can you remember the one out of 10? So you have the balance that you have accounted for here. And you have the interest that you shall receive of 800. Plus 800, which will be receivable. Yeah. The return on that particular amount to give you what? 48,800? 48,800, right? And we have bank and cash. We have what? Bank. Do you have any? Cash and cash, right? Yeah. Cash and cash is the level of 2,500. Welcome. We add that. Again on it. On it on meter. Total assets. Liability. Yeah, ordinary shares. Ordinary share capital. 154,000. Then we have another share premium. Next thing we have is a retained that. Retained I can just deal with each that. Or retained earnings. We have the trial balance 43 plus for the year. Yes, it was 16. And we minus the dividend. We pay a dividend of 30. Yeah, and you can do a working for that. 43 plus that minus 30. So 30 plus that. Is it 29? 1.5. Then you have the evaluation of 50 or 5,000. Again, what else do we have? That's all. That total. Is that? Items 145 good land and current liability. You have to find the components have to find this one 72 plus we transfer what? Note number 6. The transfer of 600 is to be made. I'll say that. We shall have 78. And you have the obligation and lease. Obligation and lease. The long term, this one, at the end of the year. 41, 984. We and you add that, and the end of the year will be 49, 720, 784. Is that okay? What current? Ability. Get a table. Try table. Is it 30? 30. And then obligation underneath. There are normally two. One is long term and the other one is short term. The short term will take the principal, these two. Principal, the last two. And you add that to 7166 plus 7525. Will be 14. 691 is what and that is. Then you have the current tax. Current tax. We have the current tax here. Where is it? The tax. I think the tax we not do it as a working. We had 5. The 5 is not number 5. 5 minus, so you have transferred 6 to the deferred. This is all that you have transferred. Here maybe 44. 100. And that's all. That we had. We have included all the necessary items. So when you add that, 30 plus 44. We give you 49. 49, 091. When you add that, the 3 of them, that's 49, 784. You add 188, 145. And then it should give you 27? 27. We're getting what? Yeah, 27, 0, 20. And a difference of? The 5,000 is not number 1, huh? The very 5,000 that we had in note number 1, where they were credited, the customer paid a deposit of 5,000, which Dodoma credited in sales account. Dodoma has not made any adjustment to inventory on the account of the deposit. And here we have adjusted. I don't know why still it is bringing that particular difference of difference of 5,000 still. Just a minute. So the only thing. Yeah, okay. So we are adjusted in one area, but already it was done in sales. 5,000, and the 5,000 from valuation we have included. You wonder why? 945, 5,000, 188. Let's pay that way. So we eliminated it in the closing. It has reduced closing. Yes, let's just leave it at that. Yeah, here. That's where the problem is coming from. 90 minus 5? Uh-huh. 85. So, 100 minus 85? Because I don't know how we ended up arriving at at 5, right? So need 15, huh? Which means then it will be more. So that means our evaluation should be 15. Our evaluation should be 15 into 5. So this revolution should be 15,000. Yeah, this should be 15. And this is 15. This will increase to 31. 31. So here it should be 15. And that is 15. This will increase by 10. 98. 98. You minus that when you add 98 on 45. 49,784. 49,081. So it gives the correct answer. No, 297 now. So this one now becomes more. Because it increased.
5,000.
Yeah, it's now more by 5,000. 48, 45. Great. So the question will be now, if not number 1, whether the customer paid a deposit of 5, which Dodoma Limited credited to its revenue account. Dodoma Limited has not made any adjustment to its inventory on account of this deposit. Because I'm not looking at the double entry, whether that amount was included in cash. So there's a possibility the amount was not included here. So we shall add. Yes? Yeah, cash and cash. See, I'll use a deposit. It was credited. Shall we include it a 5? Either 29. Either 113. This will be a 7. We will go with the assumption that it was not credited in cash. It was not debited in cash. Because kama haikutolewa kwa revenue, ilidepositiwa to a sales. So there's a possibility in the cash was not recorded. Okay, like that.